Hey everyone, and welcome back to the channel. Before we dive into today's topic, I need to share something that is going to blow your mind. According to the latest blockchain analytics data, 73% of Ethereum holders are sitting on their ETH doing absolutely nothing with it. They're not earning staking rewards, they're not participating in DeFi protocols, they're just holding. And while they're doing that, they're missing out on what could be thousands of dollars in passive income every single year. Now, if you are one of those people thinking, well, I am just playing it safe by holding, I get it. But here's what is crazy. By doing nothing, you might actually be taking on more risk than you realize. Let me explain why. Picture this scenario. You are like David, a software developer from Seattle who bought 10 ETH back in 2020, one when it was around $2,000 per token. That is a $20,000 investment. David's been holding ever since, watching the price go up and down, but never really doing anything with his ETH. He figures he is being conservative, right? Wrong. Here is what David doesn't realize, and what most people don't understand about crypto investing, is that Ethereum fundamentally changed in September 2022 with something called the merge. This wasn't just a technical upgrade, it was a complete transformation of how the Ethereum network operates. And if you are not adapting your strategy to this new reality, you are literally leaving money on the table. Want to know what is really crazy about this? The Federal Reserve keeps raising interest rates. Everyone's talking about getting 4 to 5% returns on savings accounts and treasury bills. But ETH staking is currently yielding around 3.2% annually, and that is just the base rate. When you factor in the additional opportunities available through liquid staking protocols, we're talking about potential returns that make traditional savings look like pocket change. But here's where it gets interesting, and this is something that even experienced crypto investors often misunderstand. There is this whole ecosystem of what we call ETH derivatives, or flavors of ETH, that most people have never heard of. We're talking about wrapped ETH, liquid staking tokens, and a dozen other variations that each serve different purposes and offer different risk-reward profiles. Warren Buffett always says, risk comes from not knowing what you are doing. And when it comes to these ETH derivatives, most people are flying blind. They see tokens with names like STETH, RETH, KETH, and they have no idea what they are, how they work, or why they might be trading at different prices than regular ETH. This isn't just academic knowledge we're talking about here. According to DeFi data, there is over $45 billion locked in liquid staking protocols right now. That is billion with a B. These aren't just crypto degens gambling with their lunch money. We're talking about institutional investors, hedge funds, and smart money that understand something most retail investors are missing. In the next 25 minutes, I am going to break down everything you need to know about the different types of ETH tokens, how liquid staking actually works, and most importantly, how you can position yourself to benefit from this massive shift in the Ethereum ecosystem. You'll learn why some of these tokens trade at premiums or discounts to regular ETH, how to evaluate the risks and rewards, and what the smart money is doing right now that retail investors aren't. This isn't the generic crypto advice you'll find on Reddit or in those get-rich-quick YouTube channels. We're going to dive deep into the mechanics, the economics, and the real-world implications of these different ETH flavors. And by the end of this video, you'll understand why ignoring liquid staking in 2024 is like ignoring the internet in 1995. If you are serious about understanding the future of Ethereum and crypto investing, hit that subscribe button and ring the notification bell. The insights we share here could literally transform how you think about crypto portfolio management. And drop a comment below. I want to know, are you currently staking your ETH? And if not, what is holding you back? Alright, let's dive into the real stuff that is going to change how you think about Ethereum investing. So let's start with the basics, because I guarantee most people watching this video don't fully understand what happened when Ethereum moved from proof of work to proof of stake. And if you don't understand this fundamental shift, you can't possibly make informed decisions about these different ETH tokens. Before September 2022, if you wanted to earn yield on your ETH, you had two options: lend it out on platforms like AAV or Compound, or provide liquidity to decentralized exchanges like Uniswap. Both of these strategies came with significant risks: smart contract risk, impermanent loss, liquidation risk. It was complicated, and frankly, most people just held their ETH and hoped the price would go up. But then the merge happened, and everything changed. Suddenly, ETH holders could earn yield simply by participating in the network's security through staking. No complex DeFi strategies, no impermanent loss, just pure network rewards for helping secure the blockchain. Sounds perfect, right? Well, here is the catch, and this is where most people get stuck. To stake ETH directly on the Ethereum network, you need 32 ETH. At today's prices, that is roughly $80,000 to $100,000, depending on when you are watching this. Plus, once you stake your ETH, it is locked up. You can't trade it, you can't use it as collateral, you can't do anything with it except wait for your staking rewards. For most people, this creates a massive problem. Maybe you don't have 32 ETH. Maybe you do have 32 ETH, but you don't want to lock it up indefinitely. Maybe you want to maintain some liquidity for trading opportunities or emergencies. This is where liquid staking protocols come in, and this is where things get really interesting. Think of liquid staking like this. Imagine you want to invest in real estate, but you don't have enough money to buy a whole property. And even if you did, you don't want all your money tied up in something you can't easily sell. So instead, you buy shares in a real estate investment trust, a REIT. You get exposure to real estate returns, but you maintain liquidity because you can sell your REIT shares anytime. Liquid staking protocols work the same way for ETH. You deposit your ETH into a protocol like Lido, Rocket Pool, or Coinbase's ETH, and in return you get a liquid staking token that represents your staked ETH plus accumulated rewards. You are earning staking yields, but you still have a tradable token that you can use in DeFi protocols, trade on exchanges, or use as collateral. But here's where it gets complicated, and this is crucial to understand if you are going to navigate this space successfully. These liquid staking tokens don't always trade at the same price as regular ETH. Sometimes they trade at a premium, sometimes at a discount, and understanding why this happens is the difference between making money and losing money in this space. Let me give you a real example that happened during the March 2023 banking crisis. When Silicon Valley Bank collapsed and Signature Bank went under, there was massive fear in traditional markets. Crypto markets were also spooked, but something interesting happened with liquid staking tokens. While ETH dropped about 15% during that week, Lido's ETH token dropped nearly 25%. Why? The answer comes down to liquidity and market mechanics. When people panic, they want to exit their positions quickly. But liquid staking tokens, despite being liquid, often have less trading volume and market depth than regular ETH. So when selling pressure hits, these tokens can depeg significantly from their underlying value. Here is what is fascinating though, and this is where sophisticated investors make money while retail investors panic. That ETH discount represented a massive arbitrage opportunity. You could buy ETH at a 5 to 7% discount to ETH, knowing that over time, as long as the Lido protocol remained secure, that discount would close. And it did, within about 6 weeks. ETH was back to trading at par with ETH. This brings us to one of the most important concepts in liquid staking, the difference between price and value. The value of a liquid staking token should theoretically equal the amount of ETH you can redeem it for, plus accumulated staking rewards. But the price, what people are willing to pay for it on secondary markets, can vary significantly based on market conditions, liquidity, and sentiment. Now, let's talk about the different protocols and why they matter. Lido Finance is the biggest player in this space, controlling about 30% of all staked ETH. When you stake with Lido, you get ETH tokens that are supposed to be redeemable one-to-one for ETH plus rewards. Lido uses a network of professional validators, and they've built integrations with dozens of DeFi protocols, so your ETH can be used almost anywhere regular ETH can be used. But here is something most people don't realize about Lido. It is not actually decentralized in the way many people think. The Lido DAO controls which validators get to participate in the protocol. And there is ongoing governance debates about whether this level of centralization is healthy for Ethereum's long-term decentralization. Rocket Pool takes a different approach. It is designed to be more decentralized, allowing anyone to run a validator node with just 16 ETH instead of 32. When you stake with Rocket Pool, you get ETH tokens. The interesting thing about ETH is that its value is designed to increase over time relative to ETH, rather than maintaining a one-to-one peg like ETH. So if you hold ETH for a year, you might be able to redeem each ETH token for 1.03 ETH, reflecting the accumulated staking rewards. Then there is Coinbase's ETH, which is backed by the largest US crypto exchange. The advantage here is regulatory clarity and the backing of a publicly traded company. The downside is that you are introducing counterparty risk. If something happens to Coinbase, your ETH could be at risk. Here is where this gets really interesting from an investment perspective. Each of these protocols has different risk profiles, different reward mechanisms, and different levels of DeFi integration. Smart investors don't just pick one, they diversify across multiple liquid staking protocols to optimize their risk-adjusted returns. But there is another layer to this that most people completely miss, the composability factor. This is where liquid staking tokens become incredibly powerful. Because these tokens are liquid and transferable, you can use them in other DeFi protocols to earn additional yield on top of your staking rewards. For example, you could stake your ETH with Lido to get stETH, then deposit that stETH into AAV to earn lending interest, then use that as collateral to borrow stablecoins, then deposit those stablecoins into Curve Finance to earn trading fees and governance token rewards. Suddenly, you are earning yield from 4 different sources: ETH staking rewards, AAV lending interest, Curve trading fees, and governance token distributions. This is what we call yield stacking, and it is how sophisticated DeFi users are generating returns that make traditional finance look prehistoric. But, and this is a big but, each additional layer adds complexity and risk. Smart contract risk, liquidation risk, governance risk. It is not for everyone, but understanding these possibilities is crucial for anyone serious about crypto investing. Now, let's talk about something that keeps me up at night, and it should concern anyone holding these tokens, the withdrawal queue problem. When Ethereum enabled staking withdrawals in April 2023, it seemed like liquid staking tokens would become truly liquid. You could always redeem them for the underlying ETH. But there is a catch. The Ethereum network can only process a limited number of withdrawals, per Dalton Y. Currently around 1,800 validators, which equals about 57,600 ETH. That might sound like a lot, but when you consider that there is over 30 million ETH staked across all protocols, you start to see the problem. In a major market stress event, if everyone wanted to exit their staking positions simultaneously, we could see withdrawal queues that last for months. This is exactly what happened during the Terra Luna collapse in May 2022, before withdrawals were even enabled. Liquid staking tokens depegged significantly because people realized they couldn't actually exit their positions quickly. The market was pricing in this liquidity risk, and rightfully so. Here is what this means for you as an investor. Liquid staking tokens are not as liquid as regular ETH, especially during times of market stress. If you are holding these tokens, you need to understand that in a worst-case scenario, you might not be able to exit your position quickly at fair value. But here is the flip side, and this is where contrarian investors make money. These periodic depegging events create incredible opportunities for people who understand the underlying mechanics and have the patience to wait for normalcy to return. Every time there has been a significant depeg event, patient investors who bought the discount have been rewarded handsomely. Let me share some data that illustrates this point. During the FTX collapse in November 2022, stETH traded at a discount of up to 4% to ETH. Investors who bought stETH during that period and held it for 3 months saw not only the discount close, but also earned additional staking rewards on top. That is a risk-adjusted return that is hard to find anywhere else in traditional finance. This brings us to a crucial point about portfolio allocation. How much of your ETH should be in liquid staking tokens versus regular ETH? There is no one-size-fits-all answer. But here's how I think about it. If you are a long-term holder who doesn't actively trade, and you understand the risks we've discussed, having 50 to 70% of your ETH in liquid staking tokens probably makes sense. You are earning yield on money that would otherwise be sitting idle, and you are still maintaining some liquidity for opportunities or emergencies. But if you are an active trader, or if you might need to access your funds quickly, or if you are not comfortable with the additional complexity and risks, keeping more of your ETH in its native form might be the right choice. There is no shame in simplicity, especially in a space as complex as DeFi. Let's talk about something that is coming that could change everything. Ethereum's next major upgrade, which includes improvements to the staking mechanism. Without getting too technical, these upgrades could significantly reduce withdrawal times and improve the overall user experience of staking. If successful, this could eliminate much of the liquidity premium that liquid staking tokens currently command. What does this mean for investors? If you are holding liquid staking tokens primarily for the liquidity premium, you might want to reassess your strategy as these upgrades approach. But if you are holding them for the staking yields and DeFi composability, these upgrades are probably net positive for your position. Here is something else that is not getting enough attention: the regulatory landscape around liquid staking. The SEC has been making noise about whether staking rewards should be considered securities and how they'll regulate staking services. While nothing concrete has happened yet, regulatory clarity, or lack thereof, could significantly impact the liquid staking ecosystem. Coinbase has already faced some regulatory scrutiny around their staking services, and European regulators are developing frameworks for crypto staking. As an investor, you need to stay informed about these developments, because they could affect the viability and profitability of different liquid staking protocols. Let me give you some practical advice for navigating this space. First, never put all your ETH into a single liquid staking protocol. Diversification isn't just about asset classes, it is about protocol risk too. Spread your liquid staking exposure across 2 to 3 different protocols with different risk profiles. Second, understand the withdrawal mechanisms for each protocol you use. Some protocols have built-in liquidity pools that allow for instant withdrawals up to a certain amount. Others rely purely on secondary market trading. Know what you are getting into before you commit your funds. Third, pay attention to the discount fee premium dynamics. If liquid staking tokens are trading at significant premiums to their underlying value, that might not be the best time to enter. Conversely, significant discounts often represent opportunities, but make sure you understand why the discount exists before jumping in. Fourth, consider the tax implications. In many jurisdictions, staking rewards are considered taxable income when received. Liquid staking tokens that automatically compound rewards might create ongoing tax obligations, even if you never sell. Consult with a tax professional who understands crypto before making significant allocations. Here is something that might surprise you. The liquid staking space is still incredibly early. We're talking about a market that is less than 2 years old in its current form. The protocols are still evolving, the user interfaces are still clunky, and most people still don't understand how any of this works. That is both a risk and an opportunity. The risk is that we're still in the experimental phase. Protocols could have bugs, governance could make bad decisions, and market dynamics could change in unexpected ways. The opportunity is that early adopters who understand these systems and navigate them successfully could see outsized returns as the space matures and becomes more accessible to mainstream investors. Think about it this way: we're at the stage with liquid staking that we were with online banking in the late 1990s. It works, it offers clear advantages over the old way of doing things, but it is still complicated enough that most people stick with what they know. The people who embraced online banking early got access to better rates, more convenient services, and a head start on digital financial management. The same dynamic is playing out with liquid staking. But here's what I want you to remember above all else. This isn't about getting rich quick or finding the next 100x token. Liquid staking is about optimizing your long-term ETH holdings to generate sustainable risk-adjusted returns. It is about understanding the evolving infrastructure of the Ethereum ecosystem and positioning yourself to benefit from that evolution. The people who are going to win in this space are the ones who take the time to understand the mechanics, who diversify appropriately, who stay informed about protocol developments and regulatory changes, and who have the patience to let compound returns work their magic over time. Here is my final thought, and this is something that applies whether you are dealing with liquid staking tokens, traditional investments, or any other financial decision. The biggest risk isn't the risk you can see and measure, it is the risk of inaction. While you are sitting on the sidelines trying to figure out the perfect strategy, time is passing. Opportunities are being missed, and inflation is eroding the purchasing power of idle assets. You don't need to understand every nuance of liquid staking to get started. You don't need to have a PhD in blockchain technology or years of DeFi experience. You just need to understand the basics, start small, and learn as you go. The cost of education through small measured experiments is almost always less than the cost of waiting for perfect knowledge that never comes. If you found this deep dive valuable, smash that like button, and let me know in the comments what aspect of liquid staking you want me to explore further. Are you curious about the technical mechanics? Want to see a comparison of different protocols? Interested in advanced strategies for yield optimization? Your feedback drives the content we create here. And if you are not already subscribed, what are you waiting for? We're building a community of people who want to understand the future of finance, not just speculate on price movements. Hit that subscribe button and join us on this journey. Remember, the best time to start learning about liquid staking was when the merge happened in 2022. The second best time is right now. Your future self will thank you for taking the time to understand these systems while they're still in their early stages. The question isn't whether liquid staking will become a dominant force in the Ethereum ecosystem. The data shows it already is. The question is whether you'll be positioned to benefit from that trend, or whether you'll be watching from the sidelines wishing you had acted sooner. A quick but important disclaimer: this content is for educational purposes only, and should not be considered as personalized financial advice. Cryptocurrency investments carry significant risks, including the potential for total loss. Please consult with a qualified financial advisor before making investment decisions. Past performance does not guarantee future results.